Good afternoon, everyone, and welcome to our Aero Liquid Alts Q4 2023 Outlook and Q3 Review. My name is John Graham, Head of National Accounts and ETFs for Aero Capital Management based in Toronto. Very happy today to be joined by Jim McGovern, David Page, and Chung Kim, our portfolio management team. Today, we're going to be going through a number of our different liquid alternative strategies, what we're currently investing in, and what we intend on allocating capital to in the next quarter. Next slide, please. On background for Aero Capital Management, we've been in business for just over 20 years now, and are an award-winning asset management firm. We have global expertise in liquid alternatives and active portfolio management. Current AUM is $1.6 billion, and we're a privately owned corporation and an employee-owned corporation. We have offices in Vancouver, Calgary, Winnipeg, and Toronto. Speaking today will be Jim McGovern and Chung Kim. Jim McGovern is the founder of Aero Capital Management, having started it in 1999. I'm very happy to have Jim on board today. He was previously the CEO and executive of BPI Financial Corporation, and he's the lead manager for the Aero Global Multi-Asset Alternative Class, which we're going to discuss today. Also joining us is Chung Kim, who joined the firm in 2020. He is the lead portfolio manager for the Aero Opportunities Alternative Class, as well as the co-manager for the Aero Long Short Alternative Class, the mandates we will discuss. Just to give a broad overview of the different mandates and how you could expect them to perform for your client portfolios, starting on the left with the Global Asset Alternative Class. This is a macro process which a targeted return of 6 to 8% through a cycle. It is global and it does invest in many different asset areas. You expect a low drawdown. So from a very top-down perspective, it is a very low-risk portfolio that you can incorporate into your client portfolios to either reduce overall portfolio volatility with something which is very non-correlated, or alternatively replace fixed income with something which would provide similar return expectations to that asset class. Moving to the middle, the Aero Long Short Alternative Class is a fundamental and macro combination which targets higher returns in the mid-high single digits with moderate volatility and can invest in a lot of different areas as well. And lastly, the Aero Opportunities Fund is fundamentally driven. It is the most performance-oriented of the mandates and expects to have moderate volatility. It typically stays focused in the equities, but from time to time can choose to use other types of options and or asset classes. On a historical basis, the funds have done incredibly well for investors, providing risk-adjusted returns. You can see the returns at the bottom, and we'll just move on from there, Colin. So just before I pass it over to Jim, I just thought I'd set up a little bit about where we are right now. We sit with the TSX negative year to date, down about 2%. The S&P equal weight is also down about 2% year to date to the end of the quarter. Bonds in the quarter were ravaged as yields shot up very quickly. And in fact, we're starting to see something we've never seen before. There's a lot of historical things going on in the markets as we speak. Corporate bonds have reached a yield of 6.2%. Treasury yields are reaching levels that they haven't seen since basically before the great financial crisis in June and July of 2007. And they've really had an unprecedented move up in terms of how quickly it's been. Also, treasuries are currently in a drawdown of about 38 months, which is the longest drawdown in history of treasury bonds. Lastly, the USD, which was sort of written off for dead earlier in the year. Some of you may remember some of the stories around how the BRICS were going to change that, or the multipolar world was going to change it. The USD has been on a run pretty much since those stories made headlines. And in fact, over the past 10 years, the USD has appreciated against every major currency in the world. So against that backdrop, it's an exciting day to talk to Jim McGovern and our global macro team about what's going on out there, because it is a little bit confusing and there are dramatic moves as volatility has increased. With that, I'm going to pass it over to Jim to talk about the macro situation and what we see going forward.
Great. Thanks very much, John, and welcome everybody. Before we get into the meat of the discussion, I just want to briefly introduce David Page to my right. David joined the firm in the spring of this year. He's been working with us and integrating into the team. We're very excited to have David join. He's a 20-year veteran with experience both on the buy side and the sell side with global institutions like Deutsche Bank and local institutions like OMERS. So We're thrilled to have him. So he's going to set the scene for the macro environment right now. I'm going to talk a little bit about the positioning of the fund after that before turning it over to Chung. So over to you, David.
Okay, thanks, Jim, and good afternoon, everybody. So I thought we'd start this by a process of just determining what's happened over the quarter, some of which John has just spoken to, determining why we think that's happened and what we think the implications are of those moves going forward for the multi-asset space. You know, typically in these types of meetings, I understand from Jim, the standard approach is to think about and discuss where we think the path is for inflation and growth using our four-quad model approach, and from that inferring what we think the implications will be for asset prices. So in that context, if we think about what happened over Q3 from an economic variable standpoint, we probably would have expected asset prices to be reasonably well behaved. Why? As you'll see on chart number 1, which Colin has on the screen now, real GDP, pretty well behaved Q2 to Q3. The next slide will show similarly good behavior for inflation, which has steadily been softening over the course of the year to date and was in general well behaved over the third quarter. So again, that should have led to no particular surprises for asset prices. Yet we had this extreme violent move in bond yields, which John just spoke of. So typically, we would expect that to be explained by a change in those economic variables. Instead, this time, we attribute it to a particular phenomenon called the bond term premium. You'll see on the next chart a great depiction of what this strange variable looks like. And to animate what is happening in that slide there, we've split the behavior or the pattern of the term premium into two regimes. On the left-hand side, you'll see the pre-financial crisis behavior of the term premium, where it sat predominantly or almost perfectly at a positive rate. At the onset of the financial crisis, central banks were obliged to intervene in a non-economic way in markets and to essentially open their balance sheets to support asset prices across the spectrum. That has resulted in a multi-year compression or suppression of that term premium, which you can see reached incredible extremes, negative 100 basis points at the height of the COVID crisis. That has now begun to normalize or mean revert, we may say, over the long 20-odd year sample that we look at there. So today we thought we'd explain in brief terms why that term premium has been moving. And we attribute that to two developments that took place in late July. Locally, or specifically in the case of the US market, the announcement from the government that the refunding program by the US Treasury would be increased substantially. We put this down to, of course, the significant fiscal expansion that took place through COVID and then post-COVID in the form of the CHIPS Act, the Inflation Reduction Act, etc. To that period in the summer, a lot of that funding had been done through the short-term Treasury bill market. But the market has grasped the idea now that gradually in time, the Treasury is going to have to increase the maturity of the issuance. And that has put extreme pressure on long-dated yields. We have felt the repercussions of that across all asset classes progressively as the quarter has moved on. We can go to the next slide, please. But before we get into any of those details, let's just use this graph to explain exactly how that behavior has taken place. We see 3 or 4 data series here. Most importantly, the black line speaks to that term premium. Equally as important, perhaps, is the blue line. This is inflation expectations for the market. So they've been very, very well behaved over this period. So the market has not lost trust in the policymakers, but instead is technically having to digest this increase in supply and this increase in duration. The yellow line simply reflects the very accelerated move in 10-year yields over the period. The lower chart is looking at the slope of the yield curve, the spread between the 2-year note and the 10-year note, which, despite the scale, we can see has dramatically steepened over the period as the market has priced that higher term premium, which we really would explain as being the balance between demand and supply for bonds. Go to the next slide. So this leads us at an interesting point here. The market has, through most of this year, notwithstanding the volatility around SVB in the spring, has been conditioned to this thinking of a immaculate disinflation, a soft landing, if you will. Most major Wall Street firms have been strong advocates of that outcome over the course of time. So until this period, that's left volatility very low, and risk assets have behaved very, very well across the board. We have doubted this outcome for some time, as Jim has spoken to in previous meetings. And now, given this development in the market with the term premiums and the knock-on effects into other risk assets, we continue to have a very cautious view on risk going into the fourth quarter. This is also conditioned by our understanding of what the macro signals are. Despite the relatively favorable condition of the US economy, we see signals from elsewhere in the globe that, unlike the period pre-COVID, positive synchronized global growth seems to have broken down. And we see very disparate signals between regions, most notably in Europe and in Asia in the case of China, which you talked about. So what does this mean? Is the US able to weather this storm, the short-term volatility induced by the bond market, and rely on the underlying relatively solid behavior of the US economy? We have some questions about that. This next chart, unfortunately, has rather a lot of detail in it, but trust me when I say that what it effectively depicts is that over the passage of time, the positive growth outcomes have been increasingly contingent upon the US fiscal push from government spending. Consumption and investment have begun to retrench somewhat. Investment because of the high cost of capital, and consumption, we think, as the next chart will explain, is starting to moderate progressively across many cohorts within the population. Quite clearly, there was a big boost to savings as a result of many of the immediate emergency packages around COVID. And the rebound in the employment market has left households in the States to this point in a relatively positive position, which is what has enabled them to weather the tightening cycle in the States so far. But quite clearly, as we can see from this graph, that is beginning to moderate and increasingly across a larger part of the US population. So the excess savings tailwind, we think, has now turned into somewhat, or potentially somewhat of a headwind that could very well be exacerbated by, at some point in time, an increase in unemployment. Turning to the next slide you see before you, this really illustrates where interest rate policy, monetary policy now sits in the United States, and to a lesser extent in other nations, including Canada. Many of you will have heard Fed Chair Powell speaking recently about the level of real interest rates in America now being at a restrictive setting relative to where the economy's potential growth rate is. And we can see that in this graph. However, the Fed validates this as a necessary path because in order to get inflation under control, they really at this stage need to slow the economy to create some sort of output gap. So we foresee a situation where inflation will continue to be the primary target for the Fed here, and where they will keep real interest rates on a restrictive footing until they see something of a meaningful change in other signals, as I mentioned just a moment ago, primarily in the labor market. Where is that sticky inflation coming from? Well, we think it's somewhat structural. We think for the time being, inflation at 3% would be a decent outcome, given some of the issues that are faced by companies and policymakers in the US, most notably pressures in the wage market, in the jobs market through wages, the auto worker strike, etc. These are not trivial headwinds, and these are going to take some time to work their way through the marketplace. So the Fed seems keen to keep policy tight for the foreseeable future. Additionally, we think that there are other headwinds taking place now that will be gradually evolving in time for the path of inflation, whether that's medical costs, further fiscal measures that continue to compound or make the picture a little bit trickier for the Fed here to work their way through. So the easy work has been done in bringing inflation down to this point. Now the question is, at what point does growth turn over and give the Fed the opportunity to lower policy rates? We think that point is still some way off here. That means that in time, we expect to see the economy start to fade somewhat. And we expect that will lead to further dampening of performance by risk assets through the fourth quarter. Peripheral signals in the economy, next slide, please, Scott. Peripheral signals to these warning signals we're speaking of would be the tightening in lending standards here. We think that has a negative bearing on the outlook for corporations here. I think forward earning expectations remain too upbeat, and that leads us to continue to think that the equity market will be defensive into the remainder of the year.
Great. Thanks, David. Next slide. So I'll just go over a little bit of the global backdrop briefly before setting up our book and how it's positioned right now. So we currently see these stagflationary conditions continuing to develop in the relatively short term. And even though the policy response may eventually lead to what you would come to know as Quad 4 in our vernacular, the timing for that is quite uncertain. In the meantime, globally, there's, David mentioned, a number of divergences, particularly in Japan, where both growth and inflation are trending higher. You also have now the 10-year yield in Japan at cycle highs, and you have the yen at cycle lows. So we have a number of trades here looking for something to potentially break in that construct. In Europe, where they're already facing stagflationary challenges, this has been an ongoing economic underperformer, weak GDP. Obviously, the terms of trade, particularly with China, and particularly in high-value areas like automobiles, are coming under some pressure, both from regulators and politicians. The continued sticky inflation means that the ECB is going to have to remain above target, although we do see a potential a pause and eventual fall in rates there, most likely before anything would happen in either Japan or the US. So the euro has been a sort of a favorite short on that basis. So we expect a continued frustrating situation for investors in Europe in general. Next slide, please. So looking at the principal asset classes that we work with in this fund, in the fixed income market, by far our favorite investment right now are 5-year TIPS, given the kind of returns we can own, and vis-a-vis real yields right now are quite high relative to real GDP. Plus, we have that sort of kicker if inflation, in fact, headline inflation does in fact remain sticky for even longer. That inflation protection we think is quite valuable right now. Obviously, we believe the yield curve is going to continue to steepen, as David showed you in one of the slides. So we have a steepener on with a condition of a pullback in the S&P that we would expect in the next little while. Tactically, in Europe, as we mentioned, we're long German 2-year bonds right now as a proxy for the European situation and a potentially lower rates sort of longer out. That's where we see some potential falls coming. And then finally, in Japan, as I mentioned, we have a couple of different trades, particular rates trade here, where we see a lot of asymmetric opportunity, given the Japanese real rates are extremely negative right now, and that's a huge outlier versus other parts of the world. Next slide. So in equities, obviously looking at earnings expectations by both bottom-up consensus and top-down consensus, they're expected to grow 10% in 2024. Obviously, with sort of 80 basis points of cuts in 24, something really doesn't make sense here. Somebody's wrong. We think that it's a reflection more of the soft landing view, which we're not in that camp. So We think this rising bond term premium that David discussed has started to have an impact on the equity risk premium. Equities can do well if bond yields are rising because growth expectations are rising. But in this case, that's not the case, and neither is inflation. So this is really something that will feed into valuations. We think we've sort of had the first wave of that already. The next wave will be the tightening financial conditions given higher longer-term capital costs that we're now starting to get priced in, plus the fiscal impulse is due to come down as well. We just note, everybody knows on this call that it's the Magnificent Seven that really kept this market alive. The S&P 493, the Russell, basically the average stock is down now. So it'll just be a matter of when the generals are taken out and shot. On the commodity side, we're maintaining a long positioning in a commodity basket. This is a diversifier for us in that stagflation scenario. And we like gold as well as a diversifier, given different options that the U.S. government and monetary policymakers might take. Finally, in FX, we're long USD and short a basket of currencies against that, including CAD. So that sort of wraps up our positioning. You can always give us a call if you want any of the minutiae and the details on how those trades are structured and so on. So perhaps I'll turn it over to Chung.
Sure. Thanks, Jim. Thanks, everyone, for joining. So I'm co-manager of the Long Short Fund, used to be Canadian Advantage, and sole manager of Arrow Opportunities. So this performance slide just kind of shows a little bit of difference in terms of style. As John said in the beginning, long short is fundamental / macro with exposures or weightings moving back and forth from the styles relative to the risks or opportunities that we see. And the Opportunities Fund is more of a traditional long short event-driven fund that started July 1 of 2020. And we just finished our 3-year track record. And with that, I thought it was might be a good opportunity to do a bit of a 3-year look back on kind of what we've been thinking over the last 3 years, especially given the volatility and different pushes and pulls in the market. So in our view, the last 3 years, probably you could separate into two distinct regimes, kind of a risk-on environment and a risk-off environment. And before I get into that, I should actually say, just as a refresher, the Opportunities Fund is a performance-driven fund that the goal is to outperform over a cycle, to do well when times are good, and to try to protect capital when things are risky. And this slide kind of starts at inception, effectively June 30th or July 1 of 20. And there were a few distinct events that happened over this 18-month stretch to the end of 21 that kind of caused us to kind of take risk on and off. So as we kind of entered, as we start to deploy capital, obviously it was the height of COVID, lots of risk out there, but we had the view that a lot of that negativity was priced in, and we started to go long a basket of, for lack of a better term, reopening trades, kind of like airlines, cruise lines, that kind of hotels, that kind of stuff. And I think that benefited us throughout the summer. And then, if you remember, Pfizer's phase 3 data came out in November of that year, which really created kind of a risk-on impulse. And we added risk on the back of that as well, whether it's kind of reopening or just kind of across the board. And with that, we were noticing that speculation really started to build Q4 of that year. And kind of the one area that was the most obvious in our minds was SPACs. And so we started to spend a decent amount of time in that space, taking a pretty material position in the book. And our view there was pretty simple. very cheap optionality on various themes and playing potential upside speculation in the market. So that helped us Q4 of 20, Q1 of 21. And if you remember, that's obviously when GameStop hit, I think it was January of 21, it might have culminated into a bit of a blow off in Feb of 21. And that effectively was the short-term top, in my view, on super speculative risk assets. And so the jig was up for us. We reduced our SPAC book and we moved on to new opportunities throughout the summer. As we kind of enter the end of 21, we were pretty fully invested, I would say, in kind of various kind of fundamental and thematic strategies. And a couple of things changed in November. There was an obvious Fed pivot by Jay Powell. The Omicron variant hit effectively US Thanksgiving. And with that, inflation became more topical and more of an issue. So on the back of that, as we exited 21, we materially took risk off across the board, and we start to rethink about our positioning in the book. And ultimately, we entered the year in 2022 going long inflation, effectively kind of assets that would be helped by inflation. Generally speaking, resources. Maybe next slide, please, Colin. And reducing, and then maybe even going short stuff that would be hurt by inflation, specifically long duration assets like technology and consumer. And in our minds, that in kind of hindsight, that was the start of more of a risk off environment. And so the prior slide, I think, shows that we were able to perform well when we thought it made sense to take risk on. And as the environment shifted, we shifted the book, shifted the portfolio, both in terms of gross and nets. And for the first half of 22, we were effectively on that inflation trade with eyes, and obviously in between was the Ukraine invasion, which kind of exacerbated some moves. And as we entered kind of the mid part of the year, our views started to kind of shift even more in that inflation was going to be definitely higher for longer and more problematic in terms of putting the Fed into a box. And we kind of came to a baseline view that a recession was a base case view. And so mid 22, we reduced risk even more, effectively to more of a market neutral portfolio. And we've effectively been in that type of portfolio construction since mid 2022. Still obviously looking for tactical trading opportunities and kind of shifting relative to sentiment and positioning. But ultimately, our position sizes have shrunk and our net exposures have shrunk. In that environment, still, we're pretty proud that we were able to pivot, and relative to the broad markets, and this is the S&P and the TSX, still outperforming at least kind of within that time period. And we're looking forward to redeploying capital when we think it makes sense to take risk on, although we think it's still a bit too early. Next slide, please, Colin. So if anyone's been on this call or talked to me, this is probably a slide that's been in our deck for a year and a half, or like a year and a half. Nothing's really changed for us. So as I said, the recession is kind of our base case view. From a longer term perspective, we do believe there's a regime shift happening. You can call it as a deflation to inflation, long duration to cyclicals. There's a lot of other things, potentially thematically. But shorter term, with the recession, we think earnings are still too high. We think they have not played out. And given that we think that's to come, we still think it's too early to take meaningful risk. Next slide, please, Colin. So this is another slide that's been in the deck for a little bit. And so this is not exhaustive, but thinking out loud, this is kind of our view of some major themes that have been in the market for years, if not decades. And ultimately, it comes down to rates in our view. And so if you believe, and as we do, that inflation could be higher for longer, we think a lot of the themes that effectively drove a lot of capital allocation over the last couple of decades could be reversing. This is not exhaustive, but I think they all kind of rhyme with each other. And so as we exit this market and enter a new bull market in due course, we think a new regime will start leading and a new leadership will emerge. We think that'll be resources, and we think some of the old leadership, specifically stuff like technology, may underperform. Next slide, please. So when we think about a recession, we try to keep things quite simple as to why we think there's risk there. So this is just a chart of historical tightening cycles overlaid with CPI. And the peach, or whatever color that is, lines are recessions. And so this basically just kind of shows the correlation amongst those factors. So historically, when inflation is high, CPI is 5% or plus, every time a recession followed. So for us, this is not necessarily kind of like amazing economic analysis on our end. I think it's just more probabilistic relative to prior history. And our view is the higher the inflation and the faster the tightening, there's greater risk on the other side. This narrative that's been building in the market about a soft landing. So those circles kind of indicate when the soft landings happen. Those are the actual outliers. Those are not the norms. And so with that, we think the soft landing narrative ultimately is false and will prove to be that over time. Next slide, please. So this is just a very crude kind of illustration of where sentiment has gone. This is just the Google Trends overlay of searches over the last year and a half. So if you notice the orange line, that's searches for recession, and that peaked coincidentally or not so much in October of last year, which obviously with the benefit of hindsight was a low. I wouldn't call it the low, but a low. And obviously it's kind of come off since. And the blue line is soft landing searches. And over time, especially over the last few months, that's really picked up to the point where it's kind of gone to very extreme levels as of, I think that's of August and or July or August. And, I think for me, this is more of a bit of a check on sentiment and potentially positioning. And I think over the last couple of months, this actually coincides with at least a recent top in the market. Next slide, please. So I think there's quite a bit of debate. I mean, with that soft landing debate, there's quite a bit of debate in terms of tightening and the ultimate impact to the economy. Long and variable, but there, as economic data continues to be reasonably strong, I think there are growing voices out there that the tightening cycle should have hit by now. And if it hasn't hit, that's evidence of a soft landing. So we don't agree. So this is kind of historical chart of how unemployment, this is inverse unemployment rate overlaid to where the tightening cycle ends. It's actually normal for unemployment to be kind of the tightest right in and around when Fed tightening stops. And so the fact that unemployment has been very tight, or the market has been very tight for the last few months, for us, that's not evidence of a soft landing at all. If anything, that's actually quite consistent with what happens in prior cycles. And we think there are signs that that's starting to loosen, and it could be coincidental with other factors that drive some weakness from here. Next slide, please. So as Jim and David mentioned, excess savings has been kind of a big tailwind for the consumer, the market for the kind of through COVID. With the benefit of hindsight, I think if we were on this call about a year or 9 months ago, I think we've had a very similar message, but we just thought a recession was kind of more near term. That obviously hasn't happened. With the benefit of hindsight, I think the two major factors are this unprecedented fiscal stimulus that drove a big kind of move up in savings rates, coupled with kind of one-off or kind of real extenuating factors like COVID lockdowns that created, as things reopened, a different type of spending impulse than normal. And so I think that, in my view, has culminated into things being stronger and tighter for longer. I mean, putting aside other things like supply chain, et cetera. But I think those are pretty powerful factors. And in my view, I think we might be near the end of that effectively this summer. I think it was effectively peak spending, peak pricing in a lot of areas. And that is coincidental with the savings effectively running down as we speak to pre-COVID levels. So as we kind of look forward, we think the savings effectively has kind of come and gone. We think job uncertainty is starting to pick up. Obviously, rates are high and credit is becoming tighter and tighter. So we think all of this sets up for a challenging consumer going forward, which ultimately we think leads to a challenging market. So on the labor side, kind of the headline numbers still look good, still looks very tight, still looks very strong. But if you do kind of look underneath the hood, there are signs that things are loosening up. So with COVID, there was for various factors, there's a big spike in what they call the quits rate, basically kind of the number of people quitting on an ongoing basis. And that's the orange line. So there's a big spike, and that was exacerbated with how tight the market was. You could see that that's starting to peak or has peaked and starting to kind of come off, and that's coincidental or not so much with wage growth peaking. So we think that's a sign that things are loosening out there. And with that, and with the savings rate kind of going away and kind of other factors, we think that job uncertainty is starting to become kind of more prevalent and topical for consumers. And we think that's going to play out going forward. So put this together with what's happening in the banks, credit markets. So obviously with SVB, there was that was a big shock to the system, and the credit became tighter. It continues to be tight. It hasn't improved over the last couple of months or a couple of quarters. And historically speaking, this is SLU's data on the left. Historically speaking, when we're at this type of level, when it comes to credit availability, it's followed by a recession. It's a pretty good track record. I think there are some stopgaps that are happening as we speak with this huge influx of private lending, huge influx of capital into effectively hedge funds and private equity companies that are kind of winning share because the banks are kind of ceding it. Personally, I think that could be a bit of a canary in the coal mine for the market in terms of risk. But for now, I think there's a lot of liquidity still, and I think that's been helping. On the other side, on the consumer side, you are starting to see credit impulses decrease, and with that, you're starting to see delinquencies increase. You're seeing it quantitatively, you're hearing it qualitatively when you listen to the retailers this past quarter, and we think it's just starting. One more slide about the consumer. So there's, I think, I like to think about it on a wealth effect basis. I think on the left, this is kind of the net worth, kind of cumulative net worth of consumers, and obviously a big spike during COVID. And so this would be stuff like housing, stock market, inflation. And so as you see the end of 21, sorry, you start to see that peak as inflation became hot, as maybe housing kind of topped out, as well as the markets. And at the end of the day, that does impact consumer behavior. On the right-hand side kind of shows what historically happens when you do see a bit of a shock to your net worth. And this shows that usually there's a 4 to 6 quarter lag relative to when you have that shock to your net worth in terms of how it impacts your consumer behavior. So if it kind of peaked kind of Q4 or Q4 of 21 or Q1 of 22, that kind of lines us up to around now-ish, where that potentially could be starting to hit. And I mean, weak consumer obviously matters to the market. It's 2/3 of consumption. And I don't think this is a huge surprise. This is an overlay of consumer confidence to S&P earnings. Pretty good correlation. We think that the consumer's at risk going forward. So we think earnings are going to be at risk going forward with the S&P. So those are all kind of good kind of narratives, I guess. But we always like to try to see what the market is telling us in terms of price action and technical signals. So in our view, it's not very good. As kind of Jim alluded to, the breadth has been pretty poor all year. The SP is up maybe 10%, but a lot of that has been driven by a small number of stocks. If you kind of look at the top left chart, that's actually the equal weight index of the S&P, and it's actually kind of down now. I think it's down 1 and change as of today. So that's and the Russell 2000 as well as telling a similar story. That's now down year to date. I think those tell very similar stories. The average stock actually is not doing well and hasn't been for a little while. And we like to look at what sectors are leading and lagging also to see what the market is telling us. The retail sector looks like it's almost the retail and the regional bank sectors are almost back to kind of the lows of earlier this year. We think there's a risk that they break lower and take the market with it. And the last point to that is we think that supports the idea that this is more of a bear market rally versus the start of a bull market. So if a recession comes, when do we kind of start getting constructive? This slide has also been in our deck for a little while. So on average, in a recession, earnings decline about 20% peak to trough. Earnings peaked around 240, 250 on the S&P. If you cut 20% from that, you kind of get 200, 190, 200. Not shockingly, multiples compress in environments like that. We might be 17, 18 now. On average, they compress to 15. If you throw 15 on a 190, 200 earnings number, you get something around 3,000 or just under. And so I remember putting this slide in, I think when we were at 3,600, and it probably sounded reasonable. Keeping this in last quarter probably made it sound kind of silly. I mean, ultimately, we don't think things have played out, and we haven't changed this for a reason. We think this actually could play out. We're not, it's not like we're going to use this as kind of the be all and end all, but I think it's a good thought exercise relative to how the market tracks in regimes like this to try to get a bit of a sense of where things could go. From an economic data standpoint, that should coincide in our view with bottoming out of leading indicators like PMI, ISM, topping out of stuff like claims, but we're obviously not there yet. I think people have said to me, I mean, like this, even if you're right, how do you make money in this environment? And why would we put money in your fund if that's true? Why can't we just kind of buy T-bills? And I think that's a fair question, especially given where things have gone with rates. At the end of the day, we're always looking for opportunities, and we think they're always there, long and short. And even with kind of our kind of higher level view, there's always a bull market somewhere, and there's always ways to make money. And here's just a few examples of where we think they could be. So we're big bulls on uranium, medium term, long term. We're big bulls on energy, medium term, long term. We think there could be a super interesting trade, both on the long and short side happening, which is developing over the last couple of quarters on these GLP-1s, which is that asset class of diabetes drugs that people are using to kind of take to lose weight, Ozempic and such. So we think that potentially could be a huge potential behavioral game changer for the market, for the economy. And there could be a lot of different knock-on effects. And we've been doing a decent amount of work on that. And kind of given our view of the market, we think there's money to be made still on the short side. Some areas that we like: consumer, credit, financials as a whole, and companies with high leverage that need to roll paper over at high rates. So our positioning hasn't changed much over the last little bit. We're still in capital preservation mode with tactical, opportunistic trading opportunities. Our cash levels are higher than normal. Our exposure to very low. Our biggest exposure right now is energy, and our biggest underweight or short is financials. So I'll pass this back on to John.
Great, thanks very much, Chung, and thanks very much to Jim and David as well. That's the end of the prepared remarks. We will be having a Q&A just following the performance review. So if you have any questions and you'd like to add them into either the chat or the Q&A, please feel free. I know everyone would be welcome to answer any questions you may have at this time. Just to go through the performance on the different mandates we've been discussing today, Arrow Long Short, which has the longest track record, has been in operation since 2008. It's returned 3 times the return, give or take, of the Toronto Stock Exchange. So an annualized return of 9%. The volatility, I always point out, is just under 8%. It's about 40% lower than having just the market investing for the S&P TSX. Very low beta at 66% less than the market as well. So very much delivering on risk-adjusted returns for the clients in line with what we anticipate. Next slide, please. With the Opportunities Fund, which Chung started in 2020, has gotten off to a great start as well over its first 3 years. As Chung mentioned, it just passed its 3-year anniversary of trading. And since then, it's delivered over 100% net for clients, or an annualized 25% net return, with slightly higher volatility. So this would be the more performance-oriented or equity replacement in our strategy group. And although, as Chung alluded to right now, it's very defensive, low net, and doesn't expect to have a lot of volatility from either up or down markets. So a real focus on preserving capital right here, right now. And next slide, please, Paul. Lastly, the Arrow Global Multi-Asset Alternative, which has been in operation since about 2015. Is that right, Jim? 2015. Yeah. And it has returned about 5% net, so in line with what we anticipate, with very low volatility and very low beta. In fact, you see it's 0 beta to the MSCI World. So it's a perfect diversifier for global equity portfolios in Canada, and even, I would argue, to global bond portfolios in Canada. You also see that it has a slightly negative correlation. So Jim and the team have done a phenomenal job of producing returns, both independently of the market, but also sometimes when the markets go down, which has been appreciated by our client base. It also is a very low drawdown metric, just showing versus 25 in the market, just the downside volatility in more of a tangible way. And so we're very excited about the opportunities that we have coming up over the next few years. And looking through, I'm very happy that we've been able to deliver on our investment process, through our investment process, on what we're trying to provide for our clients. we're not typically the flavor of the month, but I'd like to think that we've been very dependable and helping people reach their investment goals. Next slide, please. So just as a key takeaway, just to go through it quickly, as I just alluded to, the team has produced superior risk-adjusted returns over the cycle for investors. That's taking into the three bogeys that we like to focus on when we're producing returns, correlation, and volatility. And we manage to all three bogeys, and we think that's very important in order to help our clients meet their goals. The proven track record is there. We have the longest track records in a lot of cases for liquid alternative funds in Canada, so that people can feel assured looking at the volatility and the returns of what they're actually investing into. It's a very good complement in diversification use for passive ETF portfolios as well as active portfolios. There's many ways you can use these types of products. I think, I was having a conversation the other day with a client who wanted to reduce overall portfolio volatility, so they were moving way down and looking at lower volatility strategies. But you could also use it to add alpha to the overall portfolio and try to enhance the returns, but maybe in a different way than you can. And lastly, Arrow prides itself on having alignment of interest between the manager and the investor. So we tend to have lower management fees than a lot of our competitors. We use hurdle rates in order to have a return over on the performance fees, over hurdle rates of managers incentivized to perform over that level. And Arrow is on an employee basis and on a manager basis, the largest investor in our own funds. So with that, I'll conclude and just check to see on the Q&A if we have any questions. I know that we did have one earlier, and I think it would probably be for Jim or for David. But the question's a simple one. It just says, we're hearing a lot about interest rates, and we rarely hear about higher. Is it higher? Is it higher for longer, or is it peaked at this point? Your thoughts?
I think the consensus view right now must be that higher for longer is the probable path. In fact, in recent weeks, although we've had slightly different rate decisions from central banks, some tightening, some taking a pause, the inference from all of them is that they stand ready to act with higher rates if necessary, should inflation, continue to be sticky. We don't think that is that great of a risk at this point. I think it's more about the signaling that accompanies any decision. So we recently had the ECB, for example, tell us that they're ready to take a pause. Inflation, since they've made those signals, has been pretty well behaved, but it's still relative to where their target inflation level is, double the rate. So out of sheer necessity, as we mentioned in our presentation earlier, rates are likely to have to prevail at these levels for some time, unless something breaks, and ostensibly we think that would have to be a signal from the labor market.
Right. Thank you, David. That's a great answer. And just one for Jim as well. You've long been a US dollar bull, and it seems like your portfolio still reflects that. How much higher and how much more strength does USD have?
Well, when you're talking about the US dollar, you're always sort of referencing against another currency, a pair. Obviously, we've been quite bearish on the Canadian dollar and remain so for a lot of reasons. Probably the most important is it's a heck of a good diversifier in terms of if you want to short growth as a factor, being short the Canadian dollar is a good way to go. Obviously, the risks of that, Chung mentioned the energy situation, and energy has been very favorable in terms of trade for Canada. That being said, I think everybody on the planet knows we have a real estate issue here, and quite a bit of pressure on the Bank of Canada now being delivered by politicians and by homeowners and such. We think that Bank of Canada is in a bit of a bind. They've got to talk the game, but they're in no position relative to the United States to raise rates. Canada has a different structure, mortgage structure. They also, in America, they termed out high yield, they termed out investment grade, they termed out mortgages when rates were, close to nothing. And so they've got more wiggle room in terms of this higher for longer theme, whereas Canada, the UK, and some other markets don't. So we still like this trade. Obviously, it moves around a little bit, but our target's kind of like 139, 140 by year end.
I'd add one point as a general observation, and I believe we may have inferred it in our deck there, that the strength in the US dollar right now is in many ways reflecting this global growth divergence. And when I spoke earlier, I talked about how prior to COVID, growth globally was relatively synchronized, as Chung has mentioned in his winners and losers slide, or drivers and new drivers. Globalization to deglobalization, or globalization light, whatever you want to call it, is showing up after the pandemic as sort of cracks in that global system. So the weakness in China, the inability to forge a really powerful policy response there, the lack of fiscal drivers in Europe versus the US economy that's, albeit with higher rates, has had a very supportive fiscal stance, is leaving us with this relative growth differential that we think is supporting the US dollar, quite significantly at the moment. When the US turns down, I think naturally we would say, well, that's probably going to be bearish for the US dollar. The question that remains unanswered, and what we aren't going to know for a while, is if the US, which has been supporting things, turns weaker, how much weaker do these other places get to be? Lastly, I'd say some of these flows that are supporting the dollar are because asset markets in those countries are doing really poorly. If you look at Euro stocks, so forth, they're doing quite badly. And flows suggest that a lot of that European money is finding its way into where? US dollar mega cap stocks. So there are some cross market flows there that I think just tell us the confidence in the dollar for the time being remains high, and the investment alternatives elsewhere just yet are not compelling enough.
Great. Thank you, David. We've reached time. We're at 2:01, so I think I'll conclude our meeting today. Any other questions in the queue, we'll get back to. I'd like to thank everyone for tuning in today. If you have any further questions, please contact your regional wholesaler for Aero Capital Management. I'd like to thank Jim McGovern, David Page, and Chung Kim for spending the time with us today to go through the decks and through their outlooks, as well as to Colin Whitehead for quarterbacking the entire operation. Thank you very much, everyone. Have a great afternoon.